Hey there, I'm Marty Sakata, host of Resilient Alpha. You might know me from the Ivy Family Office Network, almost 3 decades of family offices and big shots collaborating on alternative investments, strategy, and good causes. That's the fuel for this podcast. Why Resilient Alpha? Simple. Why do some funds and managers crush it and others crash? We're cracking that code, redefining alpha, and bringing top brains to unpack asset classes and hot alpha ideas full throttle. Buckle up and enjoy the ride.
Welcome back to Resilient Alpha, the podcast where we explore emerging trends, what's exciting and going on in the alternative investment space. I recently had the privilege of sitting down with my dear friend of 35 years, Chip Perkins. Chip is the founder and managing director of Perkins Fund Marketing, which is a FINRA registered broker dealer that has revolutionized capital raising for the alternative investment space, mainly in hedge funds and private equity. Chip has raised what I view as an impressive $7 billion for these kinds of firms, leveraging his deep investor relationships and innovative marketing strategies to drive his clients' success. He leads Perkins Fund Marketing and is at the forefront of connecting managers with investors in what I think is today a very dynamic market. In that episode, we dove into what's next for the industry, from emerging technologies to evolving investor priorities and global opportunities. Chip shared his insights on how fund managers can navigate through the rapidly changing landscape and attract capital and stay competitive. We jumped into a forward-looking conversation about the future of finance, and Chip gave us a lot of things to think about.
The content here is for informational purposes only, should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security, and is not directed at any investors or potential investors in any featured fund or deals on this video.
Welcome to today's edition of Resilient Alpha. In this episode, we're going to dive into what's next for the alternative investment industry, from emerging technologies to evolving investor priorities, global opportunities, and hear from my friend we just figured out, because I met you before your kids were born, 33 years, Chip Perkin, who's really been a pioneer in the capital raising business. So, Chip, thank you for being here. We're going to look at the future of alternatives. Chip is the founder and managing partners of Perkins Fund Marketing, which is a FINRA registered broker dealer, which really has revolutionized capital raising for the alternatives business. I mean, you really were one of the early pioneers in this business, which is dating both of us because I was there too.
We don't need to go that deep into it.
You've raised something like $7+ billion for alternatives, I think mostly hedge funds, but you've been involved in private equity and I think some venture. And you've leveraged your relationships that you've built over your 30-year career. And you've always had innovative marketing strategies that allow managers to drive their success. You really are at the forefront of connecting managers with sophisticated investors, from family offices to institutions to pensions and endowments. And I'm hoping you're going to share insights with us on how fund managers can navigate the rapidly changing and difficult market to attract capital and stay competitive. So let's jump into a forward-looking conversation about the future of finance with my friend Chip Perkins.
Well, thank you, Suzanne. It's a great to be here today. Great to see you. I was thrilled when Marty said that you were going to be interviewing me, because I knew he'd maybe be a little soft on me.
But not likely. Have you ever known me to be soft?
No, it's the problem. I'm a little nervous. But I want to thank Marty and Ivy Family Office Network for hosting these podcasts and inviting me to participate with you. Thank you.
So just a little background to begin with, because it's always good to know who we're talking to. How did you get into this business? I mean, you were really one of the pioneers.
Well, it's an interesting story. I think it's interesting anyway. I was in the software business before getting into the finance business. And I had a company that had gone public, and I was introduced to a gentleman named Jim Pilata, who ran the Raptor funds, famous long short equity guy out of Boston. And I was one of his first investors because I'd never really had money until the company went public. And Jimmy said to me, you should get into this business. I said, why? He said, well, first of all, it could be very lucrative and you'd be at the beginning to use your sales skills. And I said, okay. And he said, listen, additionally, I'm very good at what I do, but you don't have enough money. You just had triplets. And I know your wife, she spends a lot of money. So I took his advice and got into the business. And the best way to get into the business is the one I've been in for the last 30 years, which is the placement of hedge funds and alternative investments.
So let's talk about what's going on in the markets. I mean, there's a lot of talk about the fact that the 60-40 model is dead or nearly dead, however you want to determine it, or that it doesn't work anymore. So if it's dead or nearly dead, in your opinion, how much of an investor's portfolio should be in alternatives? And then maybe once you allocate a bucket to alternatives, what's the appropriate diversification within that bucket?
Okay. First of all, I'm not going to be the one that declares 60-40 is dead. That's been in a lot of papers of late. I think it probably still works for some endowments or families that have patriarchs that are older that are used to that. But I think that it is dying. I think that there are better alternatives in the alternative business, allowing people to create alpha and returns differently than they have been in the last 100 years. And I think that it comes down to the risk tolerance and how big your portfolio is, as to what percentage of it should be. When I first got in this business, people said, 7 to 10% in alternatives is a perfect number. Well, the business has grown beyond that. And I think that the people running the money in the hedge fund or private equity or venture capital or whatever point you want to be into are smarter, they're seasoned. And I think there's more opportunity to create alpha with alternatives than there is in a 60-40.
Yeah, anecdotally, I'll tell you a story. I had a conversation with an investor recently. I had a conversation with an investor who's a big Yale donor who said, there's a building named after David Swenson at Yale because he was very early in this model that they call the endowment model. So he had a really diversified portfolio and he used a lot of alternatives. And so they named a building after him because he had technically given more money to Yale than anyone in Yale's history.
And that's very true.
But then I had a conversation with an investor who it's a foundation that was established when the company went public, and the foundation was given $500 million of the stock that went public. And that grew to, they kept it in the stock. They did nothing. And it grew to $50 billion.
Still good growth.
Still good growth. I'll take it. And now they've realized if they want to stay relevant and stay alive, they can't take the volatility of just being in one asset to be able to fund the projects that they've committed to and do that. And so they brought on a very high-powered CIO and have sold stock, and they've deployed $7 billion of the $50 billion, but they've got a long way to go.
Well, I need to meet
That's
them.
why I'm not telling anyone who it is.
Yeah, but I definitely need to meet them because there aren't that many guys out there with 50 billion that they want to send. So
right. Well, 43.
We'll
he's put 40. He's put 7 out, so he's got 43. But
43 is still a pretty big number.
Yeah. And given today's market, where a lot of people, because private equity hasn't given back as quickly historically, are strapped for cash.
Well, that's a big problem in the market today, from my standpoint, is investors don't have the liquidity because these 10-year lockup funds are becoming 20-year lockup funds. And
right, exactly.
No liquidity because there's not really an IPO market. And once you're a huge private equity fund, who's the biggest whale who's going to maybe come down and buy what you have in your portfolio to give your investors their money back. So it's an interesting time for a lot of strength.
It's definitely a conundrum. But let's talk about the fact that a lot of investors view alternatives as more risky. I mean, a long time in my past, I represented a long short technology manager, used no leverage, could hold as much cash as he wanted, had the ability to go long and short. And people would say, but this is really risky. And I'm like, wait a second, explain that to me, because he has more hours in his quiver. He can hold cash if he thinks the market is bad, or take advantage of alpha shorts. The guy at the mutual fund who's running the technology portfolio, he's mandated to be almost fully invested. So he's long only. And the best he can do is rotate away from the sectors that, don't look as good as some others.
Yeah, it's very different to have a hedge fund. And the term hedge comes from the ability to go long, go short, go to cash, buy different instruments that you think will either protect your portfolio or increase the alpha in your portfolio. A long-only technology manager is on the roller coaster. They can't go to cash. They have selected their stocks. Often they've selected stocks as a percentage of whatever the index has that stock at. And their portfolio is kind of locked in, and there's no, I'm underweight, Microsoft versus the index, or it's not creative. So I find that hedge funds are much less risky because often, your hedge fund could be 30% net long against the market, or 60% net long, or whatever. So you are protected just by that. So I think people are uneducated about hedge funds and how they really work.
So it's absolute return versus relative return, right?
Absolutely.
Which brings us to the issue of fees, right? Because for a number of years, there's been a big focus, particularly from the larger institutions, that alternatives are too expensive, right? I can buy an ETF for 10 basis points, or I can hire a long only guy for 1%. And, in the old days, we used to charge 2 and 20. Now it's probably 1.5 and 15.
No, in
But
the old days, we charged 1 and 20.
Oh, in the old days, we charged 1 and 20. Then it went to 2 and 20. But I've always had a view that you get what you pay for. And if I could invest in Millennium's Renaissance, Renaissance's Millennium, Medallion Fund, tripping over my words, I'd pay 5 and 50 to get that net return. I count my money, not the manager's money. And I think that's where people got a little bit lost. So how do you think about this? And do you advise your managers on how to price themselves?
Yes, I do advise them. But to the first part, I think that people have to look at net of fees returns and what are they looking for out of their investment.
Yeah, by the way, nothing drives me crazier than a manager who comes to the table with a pitch book with gross returns.
Yeah.
I'm like, I don't care about gross returns. If I give you $1, how much are you giving me back?
That is something we do not let our guys do. Everything's done in net when we report to the investor and to the databases and to the consultants and everything else, because that's the number that counts. And if you're happy with that number as an investor and you're meeting your goals and if it's a foundation or an endowment, the needs of the organization, and a pension fund as well, then who cares, what fees you're paying to get what you want. So I think that people have to look at net returns. Now, there are some people that have to look and say, gosh, I can't play 2 and 20. My investment committee will skin me alive. Well, lucky for them that most fees are going down. And I tell
But that's short-sighted of those investment committees.
It is very short-sighted. But again, they haven't been properly educated on what alternatives have to offer and net returns. That's what you got to look at.
And it's also relative versus absolute, right? I mean, when I was working at a certain firm, we hired a guy out of a long-only shop, and he sort of looked at me one day and said, wow, if our investors don't make any money, I don't make any money. And I'm like, yeah, that's how this works, right? It goes back to the days of Columbus and Isabella, right? Isabella had the money. She gave it to Columbus and she said, I'll give you the money. And if it's successful, I get 80, you get 20, right? It's a fair trade. And this guy looked at me and said, well, at my last job, the best year I ever had, I was down because I beat my index.
That's stupid.
But that's the model of the long only business.
I've never been in that world. But if you're down, you shouldn't get paid.
I'm with you. I mean, my portfolio is almost 100% alternative.
You can get the management fee because you're working hard, but you shouldn't get any kind of performance or bonus if you're down. You haven't done your job. So you asked me, do I recommend things to my clients on how they should price themselves and how they should work? And I believe that if you're a smaller manager and you're trying to grow quicker, one way is this whole thing about founders fees, where founders fees could be, if you're a 2 in 20 fund, let's say, it could be 1 in 10. And that attracts earlier investors. And I recommend to them that as the fund grows, you allow them to continue to invest additional capital at whatever that founder's fee is. And at, say, 500 million, where you're comfortably running your business and can pay for everything with your management fee, you stop charging them a management fee so that you can really reward early investors. And I think that that's key to the partnership that you develop with your limited partners.
Yeah, I mean, it's interesting. I have an investment just like that where I was a day one investor and the guy said the first 100 million that comes in pays fees until I get to 500 million and then you pay zero. And, you know, he had a bad year or two and I stuck with it because I wasn't going to give up zero fees and I believed in it. You know, and oftentimes when guys are down is when you should be adding.
Well, I don't believe in zero fees because then I don't get paid. So I don't mind if they keep the incentive fee and get rid of the management fee.
Oh, no, this guy went to 0 and 0. But finally, alternatives are, well, they've been in vogue, but hedge funds have been out of vogue, for example. And we're seeing a big new crop of managers entering the industry. What do they need to do? What skills and strategies do they need to employ to succeed in terms of attracting capital? And how do firms like Perkins Fund Marketing help them do that and support their growth?
Well, first of all, I'll say that a lot of hedge funds have been out of favor simply because the market has gone
straight up,
and you can get the market for a couple of bucks, not necessarily 2 in 20. But what's happening now, once again, is that people are looking for, let's just say in the long and short, stock pickers, people that really do the work and understand what makes a good company, what makes a bad company, and are betting long, betting short on those companies. So I'm starting to see finally a turn in people's interest. And, you know, it's not like people still don't have long, short equity or know what it is, because they do. But do they have this person, or do they have exposure to India or Pan Asia or New Zealand, or, you know, places that a lot of people haven't gone to because the U.S. market has just continued to go straight.
Do you think, other than really large managers, investors should be looking, though, at those country-specific funds? I mean, I think it's really hard. I mean, we had somebody at the Ivy Family Office Network conference yesterday, Jeff Asaph from ICG, who was like, yeah, we don't really do company-specific funds because it just can be too cyclical.
Yeah, it can be, but you also have to look at what country you're talking about. Like, I just took on an India fund. Well, India is a big market, you know, so it's just, people will have just U.S. funds, so why wouldn't they just have Indian funds? Now, yeah, if you're talking about, you know, Korea, and Thailand and New Zealand and, smaller countries, I can see why you'd want to have not direct necessarily exposure. But in the larger countries with the huge economies and huge populations with growing middle class, I think that people have to look at that differently than just, it's a country that's far away.
So that being said, going back to this idea of a whole spate of new managers coming in, how are you helping them, or how should they be helping themselves stand out and attract investors?
Listen, this hasn't changed since the beginning of investing.
Columbus and Isabella again?
Yeah, it's performance stupid. At the end of the day, you've got to perform. If you're going to take other people's money, you've got to do what it is that you signed up to do. You've got to perform. You've got to stay in the same sort of investments that you picked. I mean, one of the things that we do is we have a right to look at the full portfolio of every manager on a monthly and or quarterly basis, signed NDAs, because I don't want somebody who tells me he's a long short credit guy and I look at his portfolio and he's 75% in gold.
That's called style drift.
Yeah, it is a little bit of style drift. And we have to look out for that because we're, people are trusting that we've done the work, that what the manager says they're doing.
But the business has changed. I mean, I remember being a young woman and my father knew Michael.
Oh, you're still a young woman. Come on.
But my father knew Michael Steinhardt, right? And Steinhardt ran the first hedge funds, along with Julian Robertson and a lot of the other legendary greats. And Michael was like, I don't need marketing. If I perform, if I build it, they will come. It's like Field of Dreams. But that has changed.
Well, there were 8 funds then.
Okay, fair.
They're now, 12, 13,000 funds, something.
But so other than performance, how do you stand out? How do you, let's assume there's 5 managers that have, sort of very similar characteristics, performance-wise, team-wise, etc. How does one get the money over the other?
Well, the one thing I'll say is that this is still a people business. If you invest your IRA with Fidelity, there's some 20-year-old kid from Harvard whom you will never meet, managing that money. In the hedge fund business, private equity business, it's a bigger open to buy. So if you're going to give somebody $1 million, $10 million, $100 million, you need to know them. You need to sit down with them, look them in the eye, shake their hand, have lunch, play golf, whatever, to get to know them, to feel comfortable with them. So if you take your example of 5, and I go to dinner with all 5 of those, just dinner, conversation, shake hands, look them in the eye, ask them some questions, I'll know which one I'm more comfortable. And there may be 2 of them, maybe 3, maybe all 5 are exceptional. But you have the opportunity, or should take advantage of the opportunity to do that.
Right, but how does the manager in that situation make themselves stand out, right? Because we've talked about this, and I always say investors come from a place of no. And why do they come from a place of no? It's because it's way more important to miss a bad fund than miss a good one, because it's way harder to come back from losses. We know the compounding effect of positive returns versus having to come back from negative returns. And so, how do you help your managers get the investors to the place of yes?
Well, they got to hire me, but no. What I tell my managers is, because managers inherently are not good marketers. Some are really good.
Mark Lazary.
Again, Mark Lazary. These guys, are artists, but they also know their portfolio cold. They really know how to invest. They really understand the markets, and they can portray that and still be human and interact with their LPs or potential LPs. So we work with managers. I had a manager once upon a time who an investor would walk in the room and he'd go like this in the corner of the room and just stare at the corner of the room, answering their questions or not. And so I had to teach him to look in the eye, to engage with the people when they came in the room. And we help them, we prep them a lot on what to do. We had, thousands and thousands of meetings.
Do you ever use media training? For the manager, not you. You're obviously very media savvy.
I have never used media training. I've recommended media training for them. But
That's what I meant. Have you?
Yeah, but we do a lot of that for them, with them. And, I tell them, I remember I had a manager, I've had a lot of managers, a manager once upon a time who would bring this huge deal book into the room. She used to turn the pages on the deal book. And I said, you know what? You know all your deals, right? She said, yeah, I do. I said, okay, let's take the book, turn it around, and push it over to the potential LP.
And let them flip through if they want. Yeah.
Let them pick one. You tell them about the deal. And that's going to impress them a lot more than the fact that you've got, a 4-inch notebook with deals in it. So we work on those skills with our managers.
So you work on delivery, but what about also content? I mean, as an investor in a bunch of funds, nothing drives me crazier than having to go to a portal, sign in, remember a password to look at not even my monthly statement, but just the monthly performance of the manager or their letter or whatever it may be.
Well, first of all, we or the manager will send out a monthly email, which will talk about, your net returns, and if something went wrong, what went wrong. Okay. And not 14 pages, but, a page of information. Now, as times have changed, some of the analysts are getting younger, shockingly, and they want to text and they want to, get video clips and things like that, which, we never did, but we're starting to do things like that. We can't text against the rules. I don't know if you've ever seen all the fines in places like JP Morgan, but texting's a bad thing. But communication and information flow is a good thing. And we work very hard to make sure that people are getting what they want without having to do the work themselves. Again, it goes back to it's a partnership. I gave you the money, therefore I want information. That's your part.
Yeah, we talked about that earlier, right? You're called a limited partner, not an investor. So it is a partnership relationship.
Yes, absolutely. And you got to live up to your end of the partnership if you're the manager. And you got to make sure that you remember it's not your money. It's their money, right? And you have the responsibility and the honor of investing their hard-earned money or their well-inherited money.
Do you also, well, first of all, do you think about things like readability on an iPhone? So that if I get an email and I'm in a cab and I want to be able to see the weekly performance update or my month-to-date performance, and sometimes it's just impossible to do.
I never did because I'm not that tech savvy, but my partner, Linda Champagne, always ensures that everything is readable on a phone. And you can click on it and it'll show up on the phone, and you don't have to go like this. You can just see it and get your information.
Which is really satisfying as an investor, I have to say.
Yeah.
But we're talking about delivery of information. And, when is the most important time for a manager to communicate with? I mean, they should be communicating all the time and on a consistent basis for whatever that means for them. But when is it most important to communicate?
When you hit a rough patch. I always ask my managers to reach out on a monthly basis to, somebody. Usually their largest investors, not to be totally transparent. But when you are down.
Are you saying the little guys shouldn't get attention?
God, no. I'd never say that. the little guys should definitely get attention equally, but maybe not as many phone calls, but certainly the information flow. And I think that, you know, unless you're a gigantic firm, you know, most funds have at the most a couple hundred investors, right? And if you're down and you can explain it, isn't it nice to get a surprise call from the manager explaining, saying, hey, Suzanne, I am so sorry. We are a little down, but let me tell you why and what we're doing to, mitigate that.
Yeah, I mean, I think it's so important.
Not that you're a little investor.
And I'm a little investor. But I'll tell an interesting story. I remember in 2007, in August, which was sort of the famous quant quake, having a conversation with Izzy Englander, who runs now the almost $1 trillion firm or whatever it is, Millennium. And he was not that big then, but he was not small. And he was down, I think, 80 basis points that month, when a lot of managers who had very consistent, 1% a month performance were having down 7, 8, 10, 12 months. He called personally every single one of his investors. And he had guys in yachts in the Mediterranean saying, I've got problems. You're not one of them. Why are you calling me? And he said, because A, I haven't been down in a long time, and I'm down, and I want you to understand why. And B, you have problems, and I'm happy to talk to you about them and see if I can help you. And I've always found that being a resource to investors, even if you're trying to market to them, builds relationships.
Absolutely. I mean, if I calling on somebody and they say, Chip, I'm not interested in the book that you have. Well, I'll ask, what are you interested in? What are you looking at? What do you think you want to be investing in the next 18 months? And if I get a lot of people saying X is what they want, not Elon's X, but XYZ, I'll go look for that, because I need to add value in the process.
Well, and knowledge is power. I mean, I've always said, and I've done what you do, which is how I built the little bit of family office wealth I have. But I've always said to investors, even if they said yes to me, I see lots of things. How else can I be helpful? How can I be value added? That makes them want to talk to you more. I mean, I am working on something very small right now, but I had a guy say, look, I'm deploying money. I need bigger things initially. And I just saw something come across my desk that I think is very interesting. And I'm going to introduce him to the guy, because it gives me an excuse to call him. It makes me look potentially smart, assuming that it works. And again, it builds relationships.
Yeah, it shows that you're a team player. And I think that it's very important as we talk about partnerships, limited partners, managers, that, we as marketers become part of the partnership process. They've got to trust that we're doing good work, and that we're not trying to steer them in a poor direction.
100%. So one last question before we go to the lightning round, because this is something that has become more prevalent in recent years, and there's it's got positives and negatives, is the issue of separately managed accounts versus investing in commingled funds.
My opinion?
Your opinion. I'll give you mine.
I look at, if they want to invest with a manager and they want to invest as an LP, I'm all for it. If they want to invest as an SMA, I'll help them try and get there. There are some managers that don't like SMAs. That's because they think they've got to just do more work with it. But there are certain organizations, some of my favorites, that only do SMAs, but they've got it all set up. They do SMAs, so the manager, it's pretty transparent to the manager. They're just allocating percentage-wise to two buckets: the fund, and no different really than the fund, the offshore fund, and SMA.
Yeah, I would add, however, there are complications with SMAs because in an SMA, unlike the manager controls the fund, the manager doesn't control the SMA. So yes, there's an investment management agreement, and there's an agreement between the investor and the manager. But we all know when the proverbial,
If it gets ugly,
if it gets ugly, thank you.
you're welcome.
If it gets ugly, people sometimes bolt. And the problem with SMAs can be that you don't control it. So the investor can pull the money and you can sue them, but it's a complicated process. So it just has to be really thought through from both sides, I think.
It does. And, you got to make sure that your business isn't built on one huge SMA. Right.
Well, and that's also a good point in terms of touch on how managers should think about their investor book, just like they think about their portfolio.
Well, what we usually try and do is talk about the different kinds of investors and where different kinds of investors are comfortable coming into a fund. As an example, most pension funds won't be more than 10% of assets, but they also aren't interested in a manager that's less than $500 million.
But what's interesting about that is, I worked at a family office years ago, and the principal used to always say that he didn't understand that because he'd rather be the whale that could control that could control the process if things went bad, rather than being just one of many.
Right.
As an investor, you don't love it when somebody's the whale,
right?
Because
also,
they can tank the whole thing.
Also, I think your question was more in lines with, what do I tell the manager?
Yes.
And I don't want the
Fair
manager to be at risk because they have a whale. And
100%.
if you have a whale and they pull out, everybody else is like, what? What did I miss? What did I not know? And all of a sudden you got to run on the bank. So you've got to balance it. And I think, balance is certainly less than 50% of the fund with somebody.
But I also think it's not only size, it's investor type, right? Years ago, I worked at a fund that had 80%, 90% of their capital was from fund of funds. And when the financial crisis hit, it was a run for the bank because those assets didn't have longevity like a pension fund or a endowment foundation where the money is essentially long-term capital. And I'm not talking about the hedge fund long-term capital. Let's be clear.
Well, I agree. You need to have an investor mix. You have to have, the first thing I usually ask when I'm starting with a fund manager is, what kind of investors do you like? Who do you interact with the best? And that's usually our beginning target. We want to, provide them with what they're most comfortable with, and then introduce other kinds of investors along the way. But it's a balance. You don't want to have, 4 huge guys, because one leaves, 3 are going to follow.
100%. So this has been great, but let's go to the lightning round. Chip, this has been great so far, but it's time for the lightning round.
I've just been waiting with bated breath.
Your torture will be over soon, I promise.
That'll be good.
What investor group do you see becoming the most influential over the next 5 years?
I think that a lot of wealth will continue to be created over the next 5, 10, forever. Okay. And there'll be a huge transfer of wealth over the next 20 years, generationally. So I think that families, family offices, influential high net worth people are going to be very influential over the next 5 years. But at the same time, I think that alternatives are going to grow in RIAs, in pensions, and endowments. Now, some endowments are very aggressive. Others are not. And there's a lot of capital out there. and a lot of capital still being run at 60/40. So I think that these people, as they shift and are looking for new ways, they're going to include more alternatives. And I think that's what's going to happen.
Okay. What do you see as the next big asset class that people will or should be focusing on?
Well, I'm a partner in a ESG kind of carbon credit fund, and that area is a new area to invest in, which is going to create, I think, wealth, not just for investors, but for the local communities. We're in a nature-based, community-based carbon credit fund, and our goal is to help the people, help the environment, and of course, help ourselves and our investors. But I think things like that, mineral and mining, rare earth minerals, innovation technology,
Batteries?
battery is going to be very important, because, as you create electricity in deserts through solar, you don't have the infrastructure to necessarily get that someplace else. So batteries will capture a lot of that and then transfer it where it's needed.
So during COVID, we moved from, I don't want to say the dark ages because they certainly weren't, but to the Jetson ages, right? Where Zoom became the medium. So do you think investor meetings will go fully remote going forward? I mean, people don't have to travel. It's much easier. Will they replace in-person pitches?
Not in our industry. I think you can do a lot of due diligence with Zoom, back office to back office. I think you can do a lot of initial meetings and introductions. And yes, like if you're in Anchorage, Alaska, running the Alaska Permanent Fund, and the manager is in Key West, it's not easy to get there.
I'm not sure I'd invest with a manager who was in Key West, but
Probably
that's
not.
a different story.
Long distance. So my
Okay.
and there are a lot more there now.
Yes, for sure.
But I think that in our industry, it still is extremely important, which we have said, and we've said at the recent IvyFON conference, you got to meet the people. You got to look in their eye. You got to shake their hand. You got to understand who they are and what makes them who they are.
100%. And I think if the manager doesn't want to meet the investor, they're also making a mistake.
Oh, look, if my quick story, the quickest investment I ever had was a guy that never met the manager, and he had one bad month. Even if the manager called him, the guy didn't care because he didn't know, and he pulled his money. You've got to have a relationship with the manager in our business.
100%. What are your thoughts on retail? There's big conversations about retail investors being able to access alternatives because they haven't historically been able to because of the income thresholds, but through 401ks and the like. What are your thoughts on that?
Well, look, a lot of managers will tell you money's money, and will take any kind of money. But I think that you need to have, with that kind of money, you need an intermediary. You need to have it coming, the suggestion or the information flow coming from your registered investment advisor or your investment bank or whatever it is. I don't think that managers can handle, 2,000 IRAs in their book. So I think that you have to have a proper, knowledgeable intermediary.
What finance buzzword will dominate 2026?
I think that the financial buzzwords of 2025, be they AI, blockchain, cryptocurrency, magic beans, whatever, will go for 26 and probably 27. But there'll be something else that'll come along that will be the new thing.
What's one bold prediction for hedge funds in the next 12 months?
Growth. I think that the markets are not going to go up forever. I think there's going to be more volatility, and you're going to want to have people well versed in whatever it is that they're investing in. They can go long, they can go short, they can go to cash, they can go sideways, whatever is required So I think the growth in alternative funds is going to be extraordinary over the next 10 years.
Biggest change for alts in the next 10 years?
More money. And I think that leads to people being more careful in their manager selection. Because if a manager says to you, I can run $2 billion and give you a substantial return like I've been doing all along, they should stop at 2 billion and not become 5 or 10 billion.
Yeah, and that's a really important point that we haven't discussed, that managers who tell you what their capacity is, if they're going above that, you really need to understand it. Because if a guy, when you met him, said, I'm never going to do munis, all of a sudden hires a muni guy because he needs another avenue, that could be bad.
Yes.
So my last question, if you weren't doing second to last question, if you weren't doing what you were doing today, what would you be doing?
I really don't think, as Jeff said yesterday, I'm qualified to do much else. I mean, I was a tennis pro, I was a ski instructor, but I'm not going to be doing that anymore. But the most exciting thing that's happened to me in the last 2 years is my son joined my firm. He left Meta, left the technology business, and came to work with me. And that's extremely exciting on many fronts. And I love working with him every day. And I think he still likes me. So this is good.
That is good. And, Howard Marks always says, though, it's only work if there's something else you'd rather be doing. So my very last question, what's your proudest accomplishment?
From a business standpoint?
No, or from any standpoint.
I think probably my children are really my proudest accomplishment, and what they've done with their lives.
And you've just had a grandson, so congratulations.
I have had a grandson, and he's going to be a kick-ass kid.
I bet so. Well, Chip, it's been a pleasure having you on Resilient Alpha. Thank you so much for taking the time. And it's been just such an honor to have known you for 33 years.
Well,
we've had a lot of fun, traveled a lot of places, done a lot of things.
All above board.
Yes, 100% above board. It's not a what happens in Vegas stays in Vegas situation. I swear.
Not at all. But thank you guys for having me. This has been a lot of fun. I didn't think it was going to be this much fun, to be honest, but it's been great. Thank you.
Thank you.